HUB24 delivered a record full year, revenue growth of 37% to $74 million. I spoke with Andrew Alcock. He is CEO of HUB24 in the wake of the full year results. Began by asking how the company has been handling the first few weeks of this brand new financial year.
So we're very pleased with what's happening, and I think that's a result of the consumers and advisors needing to get their house in order in terms of looking after clients' retirement outcomes. Those things don't change. So our industry's been fortunate in regards of that.
Okay, so in the results that were released today for the full year, they did contain some restructuring costs. So what's the plan there strategically? How are you changing? And I would assume it is to improve and enhance performance.
Sure, it's all about aligning the business for the future. There's a couple of things we did. We've changed trustees, so we've selected equity trustees to be our trustee of our superannuation fund, and we're very excited about that, about having such a good trustee moving forward, looking after our members, but also helping us with our strategic objectives. So that's a change away from the old trustee. It's setting us up for the future. We're also streamlining the way we manage some of our investments, our managed portfolios. We're moving them into what you'd call an MIS structure. That's also, again, laying the foundations for us to actually include different types of investments for consumers. So we've got two different models at the moment. We're streamlining on one, and we're moving everything over into that model moving forward. It's about the future. There is another abnormal item there, which is actually the write-up, or we're not paying as much consideration for a business that we purchased a few years ago. At the same time, there's an impairment for that business because we've changed the strategy to align further in the future.
What is your key strategy?
Oh, absolutely. What we're about helping or connecting customers to innovative solutions that create investment outcomes. When you translate that to the platform, it's about growing our platform business. When you translate that to our other businesses, we have an advice licensing business and a technology business. It's about adding value in this world that is shifting. So it's about using technology to create value and change the value chain that existed before. Sounds like a bit of waffle, but we're actually doing it. We've lowered price in the industry. We're creating efficiency so we can close that advice gap as well that exists in Australia. But primarily our main economic engine is our platform business, for which we're ranked very highly and we're growing very rapidly.
Funds under management, you're forecasting that to be between $28 and $32 billion in the coming financial year. So what has to go right for that to happen?
Oh, look, we have to keep executing the way we have to date. Look, I'd like to think that we could overshoot that, and that's, aspirationally, we always want to do the best we can do. We're in a marketplace where we're unsure what's going to happen, but if we keep executing well, that will come from new clients as well as existing clients, because we have a lot of existing clients who choose to use HUB24 as a platform to look after their clients' needs as advisors. So it's getting it right, keep innovating, and keep delivering the great service we're delivering.
And will the pace, though, of growth in funds inevitably slow?
I think there's a long way to go yet. We're absolutely surprised, and maybe we shouldn't be surprised, about the fact that coming out of this negative situation with COVID, we're actually running at full speed and we're growing quite rapidly. We have 1.9% share of the marketplace. The incumbent operators, being the banks, are selling or announcing they're selling, not clear on their strategies. There's $800 billion there in that marketplace. We have 17. So I think we actually haven't even hit our straps yet in terms of the potential. We've gone from $3 billion a year to $4 billion a year to $5 billion a year this year. And with the outlook statement we've got, that requires to hit $6 billion a year moving ahead. So I think the pace will increase.
And how do you grow revenue margins? How do you grow those margins?
Oh, growing margins, well, it's interesting. We grow the size of our business. Growing margins means actually having other services to add the actual margin. Interestingly, because we operate in an environment where our rate card or our pricing is tiered, higher value clients pay less in terms of a margin sense, but more in dollar terms. So if you've got $2 million in HUB24, your percentage fees are lower than if you've got $1 million. So, margins for us are not the indicator of success. Okay. It's what are the fees you earn for each customer and what are the costs delivering for each customer. So that's expanding every year. Our fees or revenue per client is increasing and our costs per client is decreasing, and we're really leveraging our scalability in the business moving ahead.
And you can continue to lower those costs per
Absolutely.
client.
We're investing in that way now. Every year we make improvements.
And that's technological improvements,
Technological,
is it?
in some cases it's adding technology to improve operations and call centres and service things. It's about how you take on new accounts. It's about digital access. Yes, absolutely. It's usually technology that's driving the value chain here for us.
Yeah, because HUB24 was a fintech before fintechs were a thing, weren't they?
Absolutely. A lot of people say, are you a tech company or a fintech company? I like to think we're both.
Yeah.
But we use technology to create value. But it's not about us as much as we're using technology to help customers retire with a better outcome. The things that we can do with our managed portfolios to create a better outcome for you or for your friends, your relatives, in terms of minimising tax you might pay in your portfolio or lowering transaction costs, simply because we've broken down that value chain, that old managed funds value chain, we're making a difference. We've got examples through COVID where customers have saved thousands of dollars by rebalancing on our platform efficiently because of the tax modules that they wouldn't have had that opportunity to do in different environments. So the technology is helping us be efficient, but the whole aim is to help customers and advisors actually achieve goals with their customers.
Okay, final question. I mean, where do the risks lie? We're still in a very uncertain environment.
Sure.
But it could be execution risk. I mean, what sort of is the thing that you think about when it comes to moving into FY21 that you really need to get right?
Oh, look, we always have to get execution right. I think that we've been very good at balancing that. There's a bit more uncertainty about how do you balance the cost growth for the growth that's coming at the top end of the business. So it's a bit hard to predict that, but I think it's execution risk. The broader economy is a challenge for everyone. We don't know what will happen. But from our perspective, I think we just keep innovating. I think execution is the one, but to date we've done a great job on that. So if we keep sticking to our knitting and keep using that technology to break the back of problems and create opportunities, I think we'll be fine.